All right, what's up, everyone? This is Kirk here again at Option Alpha. Welcome back to episode number 22 here. We're going to be going through something a little bit different today because a lot of people ask about options assignment and expiration risk and assignment risk. So I wanted to give you a combo episode here where we're going to walk through not only what options assignment is and the risks of options assignment, how you can tell if you're at risk of assignment, but then we're also going to show you how you can use some tools on Option Alpha, of course, to manage this risk automatically with your bots and automations. So let's just jump into the slides here. We'll go through this. I hope this will be helpful just to kind of go through this process. If you're new to options trading, even if you've been around for a while, I don't think a lot of people know this process or kind of understand it. So here's how it works. So the exercise and assignment process that happens, basically, it's the same thing that happens. It just depends on what side of the trade you're on. So you will hear people say, I was assigned, or I'm exercising, or whatever the case is. It's the same thing that's happening. It just depends on what side of the trade you're on. So option buyers exercise their contracts. This is because that's what they got. That's the right they got when they bought those option contracts. They can exercise those contracts. So their desire is going to be to convert their option contract into physical shares. And then option sellers are assigned. And so when an option seller is assigned, remember, an option seller, they're giving up their right and they're accepting an obligation of assignment later in the future. And so when they get assigned, it randomly happens. This is what causes 99.9% of people freaking out about options assignment is in this process is they randomly get assigned and now they're dealt with the underlying shares. Their contract that they had is now converted to underlying shares. So again, this whole process is managed by the OCC, which basically guarantees all the trades back and forth and then ensures the obligations are fulfilled for everybody. And so what happens logistically is the option holder, the option buyer, they choose to then exercise their contract, which is an important point in this whole process because they have to physically make a choice. I'll say this over and over again, but the option buyer has to make a choice. They have to choose to exercise their contract. That means that if you think about it, they wouldn't do that unless it was financially viable for them to do it. Or another way of saying it, they wouldn't choose to do something that would then immediately lose them money by doing that thing, right? So if they choose to exercise their contract, they let their broker know. Their broker, like Tradier, would then send notice to OCC, the big OCC White House. They would randomly select another broker in their firm, right, or in their network. And then that broker would randomly select an option writer who's holding that contract short for assignment. A lot of people think that there's some kind of scheme out there to like get you. Like some people will say, I've been assigned 5 times this week, so they're out to get me this week. It's not the case. It just happens to be you. It's happened to be me. It's going to happen to you. It's a normal part of the process, okay? So let's talk about early assignment of short options. When does it happen and why? Now, I say most because we can't guarantee all the things are going to happen. We certainly don't know when assignment's going to happen, but most assignments happen closer to expiration when an extrinsic value is low. And you will be assigned early on short options that have, for example, 30 days. If you have, or you'll never be assigned, rarely be assigned contracts that are 30 days out from expiration because they just have too much time. So first thing to remember is option contracts are going to get assigned if they're very close to expiration, like the last week or the last couple of days until expiration. If an option contract has 90 days, 20 days, 30 days, 40 days out until its expiration, it's a very, 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 very low chance that it's going to be assigned, okay? Now, most assignments also occur when the option contract is in the money. That means when the option contract is having or has intrinsic value. There's value to be converted. So an option buyer would never, and again, I say asterisk because people can do stupid things, but they would never exercise their contract early if it was financially detrimental to their net position. They would never do that. They would never willingly do that, right? But some people do stupid things, so I can't say never, never, never 100%. But they really wouldn't do that. They really wouldn't buy something for $100 if they could buy it someplace else for $80. Like, it's just stupid, and they wouldn't do it. So most early assignments happen because the option buyer on the other side simply wants to convert the option contract into underlying shares. That's really the end game. So a lot of option contracts are closed before expiration. They're just reversed out. So the option buyer sells their contract. That's it, right? But in the cases where it doesn't happen, then somebody actually wants to hold the underlying shares. Now, again, you got to think about the universe of people who want to do this. Because an option contract controls 100 shares, that means that every single contract they assign is then going to be forced to controlling and buying 100 shares of stock or shorting 100 shares of stock. It's very capital intensive, which also means that it doesn't happen as often because somebody has to really want that position, right? Some need that they have for that position. Again, since it requires significantly more capital to hold the position, remember it has to be beneficial for them to do it. So let's go through some very basics. I think this is really going to help because if you don't understand the way that options are priced, you don't have to understand every single micro component of an option price, but just the broad strokes of how an option contract is priced. If you understand this, you'll understand why and when assignments can happen, and then you can kind of build automations around it. So the first thing you have to understand is that an options price or premium is basically the combination of two things. Number one is intrinsic value, and the second thing is extrinsic value. So intrinsic value is the difference between what I call the spot price or the underlying price, the current price of the market, and your strike price. There has to be value in the contract for it to have intrinsic value. There's got to be value in it if you were to hypothetically convert it right now. So that's what you always want to think for intrinsic value. Is it in the money? Do I have value right now if I were to convert the position from an option contract to the underlying shares? Basically, if I were to buy it at the strike price or sell it at the strike price, depending on what side you're on, is there value to this right now? And we'll go through an example, don't worry. The second component, broad component, is extrinsic value. So extrinsic value is made up of external factors that are still yet to be played out, right? There's no intrinsic value because we're not worried about the strike price differential right now. Now we're pricing things that are extrinsically out there. So time value, how much time until expiration, volatility value, how much time is there, like how much volatility value is there, interest rates, things like this. External factors, that's how I always think about it. External factors, extrinsic value. When there is very, very, very low extrinsic value, it becomes more favorable for an option buyer to exercise their contract if extrinsic value is low, right, or zero, and there's intrinsic value. Just makes sense, right? Like that's literally the whole thing here. An option contract is more likely to be assigned if the option buyer sees that that contract has very little extrinsic value, so no time or volatility value left, and it has intrinsic value. There's something there to capture. And so if none of those are true, it's never going to be assigned. All right, so let's go through an example. So again, you can see this is a long call option. Let's just use this as an example. But again, out of the money, or an option buyer would be in the money over here. So if you were taking the opposite of this contract, then you'd have to look for positions that were in the money where they're trading above your break evens. Okay, so let's just use an example for pricing to get back to this price example here. So let's say that you were looking at this exact contract right here. Again, somebody had bought this contract here. They bought this call option, which was $100 strike. Okay. And right now, let's say hypothetically that the stock is trading at 102. So the option buyer on the one side, they bought this call option for a strike of 100, and it's currently trading at 102. The price of the contract, the 100 strike call, is $2.38. So the question is, what is the intrinsic and extrinsic value component of that option price? So go ahead and do it yourself. Pause the video if you want to pause the video and come back to, okay? So here it is. So the intrinsic value is easy to calculate. That's the simplest, easiest thing to calculate because all you're going to do is you're going to take the difference between the spot price or the underlying price and the call strike. In this case, again, remember, if an option buyer can buy stock at $100 call strike and it's currently trading at 102, there's intrinsic value there. They can exercise their contract, buy the calls or buy the stock at 100 and immediately sell it at 102 and net a $2 profit, right? That's why the value of this contract is definitely not going to go lower than $2 because that's the intrinsic value that it has. It has value right now sitting where it is. Now, this contract, if it has $2 of intrinsic value, then the remaining portion is attributed to extrinsic value. That's the value that's left over for time and volatility. Now remember, and this is a really key component, if you are a call option buyer here, you could exercise your contract and you could buy stock at 100 and sell it at 102. But that would only net you a $2 profit. And so what you'd be giving up in this instance is you would be foregoing the extrinsic value of 38 cents or $38. So that's why a call option buyer in this example is not going to exercise their contract, because although they have intrinsic value in the contract, exercising their contract foregoes the extrinsic value that's left in the contract. They are much better off, instead of doing all the whole process of converting their option to underlying shares, they're much better off just selling the contract outright to somebody else for $238 and letting somebody else take another stab at this trade from another angle. That's it. So that's why they wouldn't do it. All right, another example here. Let's say do this one now. Let's say we have a call strike that's now at 105. So again, the stock is trading at 102 now. So I assume you're an option buyer in this case, or you can put yourself on the side of an option seller. So now the call option is trading at the call strike is 105 and the underlying spot price is 102. So the question is, if an option contract, this 105 strike call is trading for 139, what portion of the different extrinsic, intrinsic value components can we attribute to it? And the answer is this. There is zero intrinsic value for this option contract. This option contract does not have intrinsic value because a call option buyer cannot exercise. I mean, they could, but they're stupid to do so. They would exercise their call option, buy stock at 105, and then immediately sell it at 102 because that's the market price. That's stupid. They wouldn't do that. They would immediately lose $3. So the better choice is to not do anything, right? Because if you wanted to own the stock, just go out and buy it outright in the open market at 102. But in this case, they would not do that. There's no intrinsic value. So the whole value of the contract remaining is purely attributed to extrinsic value in this example. There's only time and volatility value. So even though there's extrinsic value, because there's not intrinsic value, again, they would be completely stupid to exercise their contract early. Because not only would they do something stupid where they would convert shares at 105 when they're trading at 102, but they also forego the value of the extrinsic call option that they have, which is $1.39. Instead, what they're going to do is they're just going to straight outright sell the option contract and close the position. Okay. So this is why these two components matter. You got to have intrinsic value, and the extrinsic value has to be low enough that an option buyer is going to forego that extrinsic value. Ideally, it's going to be pretty close to zero. All right, so how can we use this then to leverage automation? How can we use it to identify early assignment risk? Well, the first thing we can do is we can use a monitor automation to continuously watch our positions as they approach expiration. Remember, one of the big components of this is how close are you to expiration? The further out you are from expiration, the less you have to worry about it. The closer you get, the more you have to worry about it. So we can use a monitor automation to monitor this for us. If we determine that our positions are getting close to expiration, then we can watch the positions to see if any positions are currently trading in the money or are likely to be in the money by expiration date. Remember, if it's not in the money and if it's out of the money and there's no intrinsic value, then there's no likelihood of assignment, or it's very, 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 very low. The last thing that we can do is we can calculate the extrinsic value of those short option contracts. You can actually run a simple automation or a simple decision that actually calculates the extrinsic value. You can actually pinpoint this exact value right here. How much is this component? Or in this example up here, how much is this component here? And we can determine how much extrinsic value is left in a contract. You can then use this as a guidepost for determining if the option is likely to be assigned early. Remember, if the extrinsic value is very low, I'd say like under 10 cents or something, then it means you're at a much higher chance of early assignment. So finally, if the position is identified at risk, however you want to classify it, of early assignment, then you can have your automation close the position and then remove the risk. Okay, it can close the position and it can remove the risk. All right, so let's stop sharing those. I'm going to change over to some different slides here, guys, so we can share the screen here. Okay, let's just go through a couple different examples. I'm going to go through some positions. These are live positions that I have right now across different bots, but just to kind of show you some examples of things that I think are at risk, maybe at risk of assignment or coming close or not, or whatever the case is, or why. So this one is the shortest date to expiration one that I have, at least at this moment. I think one of my bots is going to make a trade around 2:30 anyway, but this one's the shortest date to expiration that I have. It's a GLD position, Iron Condor. But you can see right now where GLD is trading, it's about 305 and change. My short strikes are at, in this case, where's that? 305. So it's right above my short put, and 314 on the call side. So my contract, it's 9 days from expiration, but let's assume it's a day from expiration. It's not likely to be assigned at this point because it's not in the money. So the stock is not trading beyond my short put or beyond my short call. It's not in the money. Therefore, there's no intrinsic value. There's no value to somebody converting that option contract in the money. Now, this case, it is 9 days from expiration. So I would still say that the position probably is not at risk of assignment because there's still too much time left until expiration. The contracts expire May 30th, so it's another week and a half until expiration. So probably not at risk of assignment, even if it goes in the money in this case. Okay, let's look at a different one out here. So this one up here, well, XSP is a bad example because it's cash secured. Let's look at this one here, QQQ Iron Condor. Okay, so this is a QQQ Iron Condor that I've had. This thing is about, well, what is about 30 days out from expiration. Stock is trading at 515, so it's well beyond my short call strike on the top side, super far beyond my short call strike. However, 30 days until expiration, there's no chance that this thing gets assigned early because they would forego so much extrinsic value in those contracts. It's just not worth it for them to actually exercise those contracts early. So even though it's really far in the money, right? Even though there's maybe a chance that it stays all the way out here in the money, there's no chance it's going to be assigned early. So in this case, it's defined risk. I let the position go. It could swing back around the opposite direction. Okay. So just to kind of go through some examples. Now, what we can also do is we can also use automations, like I said, to basically manage this assignment risk. So in this case, if I go into my monitor automations, I have this automation here that I built out called early assignment risk, and it's called bolt-on. The reason it's called bolt-on, and maybe the guys can add a link to this in the video after we're done, but I shared a community thread where you can basically save this automation to your library of automations on Option Alpha, and then simply add it to any bot that you have. It's literally like meant to be a bolt-on attachment to help manage expiration risk. But what I'm doing here, or assignment risk, is I'm going through a set of decisions for different types of strategies and assessing the risk of early assignment. Now, these are all inputs. There's a couple different things that you can do that can make them variable for you, like the expiration days, like how many days, or the in the money probability, or the extrinsic value. So these are all controls where you can set how aggressive or how not aggressive you want to be. But essentially what the automation is doing is it's going through every position in the bot, and then it's asking the question, does the position expire soon? What do we mean by soon? This is where you'd set your expiration day threshold. You would say the position expires in less than X days, whatever the number of days is. I usually set mine to about 5 days. So if the position doesn't expire in less than 5 days, don't worry about it right now. If the position does expire in less than 5 days, and you can see everything kind of keys off of the answer yes. If the answer to this question is no, don't do anything. It doesn't do anything, right? But if it does expire in less than 5 days, I want it to go to the next stage. Now, the next stage in this case is trying to evaluate if the position is a short put spread or a short call spread or an iron condor or an iron butterfly. It's just doing a series of evaluations for those different types of positions. Let's say we have a short put spread. The position is a short put spread. It's just asking, is the position type a short put spread? Then it's going to ask the question, is the position at risk of early assignment? Now, inside of this decision block, I've used a set of grouped decisions. I'm checking 3 different things. And you might not be surprised by these 3 things after the beginning of this video, hopefully going through the slides. But number 1 is the position's underlying price below my short put strike? So in the example here for this GLD position, to go back to this tab, if I were to ask it, is it below my short put strike? The answer would be no, it's not below my short put strike. Therefore, it's not at risk of assignment. So it has to be below my short put strike for a short put spread. And the short put leg's chance of being in the money has to be greater than some input that I set, some in the money probability chance. In this case, I usually set mine to something like 70-75% chance, right? So I don't want something that's kind of sort of in the money. If it's kind of sort of in the money, like it's just barely past my short strike, that doesn't mean that I need to dump the position immediately. That's probably a little bit too jumpy. I probably need something that's really, really, really far in the money, okay? So in this case, it's got to be below my short put, and the probability of it staying in the money or being in the money is greater than, say, 75%. And if that is all true, then I'm also going to check one more thing. And the last thing that I'm going to check is I'm going to specifically get the short put leg and the extrinsic value of the short put leg. And then I'm going to see if that extrinsic value is less than a threshold I set. I set mine to around 10 cents. So if the extrinsic value is less than 10 cents, then I know I'm at high risk of assignment, right? I know I'm at high risk of assignment. If the extrinsic value is not less than 10 cents, then I know I am not at risk of assignment. It's just not going to happen, right? I don't need to manage that position because it's just not at risk of assignment at all, okay? So that's the way that we're going to check it. We're going to check all of those things. All of those things have to be true. If all of those things are true, then I tell the bot, yes, close the position and tag it early assignment risk so that I can monitor and manage it later on inside my stats and automations and tracking everything. I can see what positions were removed and why they were removed. In this case, I can just add a tag that says early assignment risk. Now you see it goes through the same types of processes for short call spreads, just in the opposite direction. So is the underlying above my short call? Is the call greater than my in the money probability chance? Is the short call leg's extrinsic value less than my extrinsic value threshold, etc.? For an iron butterfly or an iron condor, what it's going to do is it's going to do duplicates of these, but it's going to check both of these legs. So it'll check the short call strikes and it'll check the short put strikes separately, and it'll make sure that it can check both legs of that position, which is pretty clever and pretty intelligent for it to do that. And then again, if that position is at risk of assignment, it's going to close the position, okay? So these are all really, really helpful. You can obviously run tests on these if you wanted to. So let's do test on this one. I'll do this one because I know it's got a couple bots in there. I'll use test inputs of 5 days, 70%, and 10 cents of threshold. Just start it and you can see what it's doing. So I got my GLD position. That's that position I showed you earlier. Does it expire soon? The answer is no. It expires in 6 market days. So that answer is no. It's not going to go to the next step. Same thing for my XSP. Let's run a different test. Let's run this out just so we can get it inside the 7 market days for the GLD position. There you go. You can see that GLD Iron Condor position. Does it expire soon? I only ran the test at 7 days. So yeah, it says yes, 6 days. Is it a short put spread? No. Is it a short call spread? No. Is it an iron butterfly or an iron condor? Yes. And is the position at risk of early assignment? The answer is no. The underlying price is 305.50, which is above my short call, and it's 305.50, which is below, underlying price is not below my short put. So again, it's not at risk of assignment. You can see how it's going through that progression here, and it's got to be true for all of those statements before it makes the decision to take the position off. So again, all you need to do is simply go to the community post that we'll put a link to here after the show, hopefully in the description. Go ahead, save this bolt-on automation to your library, and then just simply add it to any of your bots and automations as a brand new automation. Just bolts right on top of it, but that helps you manage your positions moving forward. So I hope you guys enjoyed this one today, going through short option assignment risk, what it is, how you can manage it, how you can figure it out, and maybe some cool tools on how you can use automations to take care of the management for you. Until next time, happy trading, and thanks again.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.